Hello and welcome to this lecture. This lecture is for ACCA paper F3 Financial Accounting. The topic today is Interpretation of Financial Statements. Interpretation of financial statements is also known by the name ratio analysis. Today I am Zakaria and I will be guiding you throughout this lecture. So, by the end of this session, students will have a good understanding of what are ratios, categories of ratios, purpose and importance of ratios, using ratios for better decision making. Students will also be able to calculate key accounting ratios, profitability ratios, liquidity ratios, investor ratios, long-term stability ratios. Students will also be able to explain interrelationships between ratios. So now, let's begin with a brainstorming session. Here, all you have to do is take a pen and paper and write down some notes. Your notes need not be correct. There is no judgment, there is no marking, there is no criticism. So, write up your thoughts. That's all. What is ratio analysis? Again, there is no judgment, there is no criticism. Write up whatever you think. Have you ever heard of this topic before? If you are familiar with this subject, can you name some ratios? Can you remember when and where you studied this topic? Alright, so we are done with the brainstorming session. Now let's move on to auto-suggestion session. Auto-suggestions are affirmations which we tell to ourselves, and regularly using auto-suggestion before and after study will help us learn faster and remember easily. Auto-suggestions are affirmations which we tell to ourselves. Using auto-suggestion regularly before and after the study session will help us learn and remember easily. Today's auto-suggestion is: I can understand and remember whatever I read and hear in the class. I am able to present it very easily, both in speaking and in writing whenever I need. I can understand and remember whatever I read and hear in the class. I am able to present it very easily, both in speaking and in writing whenever I need. So now let's start with the ratio analysis. So what is ratio analysis? This is a tool used by managers, used by individuals to conduct a quantitative analysis of information in a company's financial statements. So here we will be using quantitative analysis. Quantitatives, that means quantity, numbers. So we will use figures from this year's financial statements and compare it to our previous year's financial statements. We can also compare our financial statement figures to a competitor's figure only to find out what is our performance. Ratios are calculated from current year numbers and are then compared to previous years to judge the performance of the company. Alright, there are many ratios, and ratios can always be made to suit our own needs, but there are few categories. Mainly there are 4 categories of ratios under which we sort out the other ratios. The categories are as follows: profitability ratio, liquidity ratio, long-term stability ratios, and investor ratios. These are the main 4 categories. For profitability ratio, we will be finding out how profitable is the business compared to its previous years or compared to its competitors. Liquidity ratio. This shows how much liquid is the business. What is the cash position of the business? Can the business pay out to its creditors and pay out to its payables and then survive in the longer term? It also shows the company's solvency. It indicates the going concern position of the company. Then comes the investor ratios. Every now and then companies need to invest, but for that they need to invest wisely. Where to invest, which shares to buy, in which company to invest, all these decisions will be based on the ratios. Then comes the long-term stability ratio. As the name suggests, how much stable is the business? Through this ratio, we can find it out. Is the going concern status of the business affected or not? There will also be signals through this ratio. This ratio also deals with the long-term loans of the business. Now, let's get to the first category of the ratio, profitability ratio. Under profitability ratio category, we have four main ratios: gross profit margin, net profit margin, operating profit margin, return on capital employed, and return on assets. Profitability ratio. Under profitability ratio, we have this gross profit ratio, gross profit margin ratio. Gross profit margin ratio is calculated by gross profit divided by sales revenue into 100%. These ratios are always expressed as a percentage. Many ratios will be expressed as times per year. This ratio is 10%, 20% per year. For example, XYZ company, one of the directors of XYZ company has communicated to you, and he wants some suggestions. He comes and tells you that one of the managers who is newly appointed for the last 3 periods has shown growth in gross profits as shown in the screen: 25 in the first period, then 50 million in the second period, and then 75 million in the third period. And he has brought down this chart and he wants a bonus or a pay rise. This director is a bit confused. He thinks there might be some manipulation here, but the other directors are really happy. But as you are the financial consultant, he wants to know more, and he wants to know, is everything alright? And he wants a suggestion whether to give him a pay rise or not. So, because we have the tool of ratio analysis, we know gross profit divided by sales will give us the gross profit margin. So what we will do here is gross profit 25 divided by sales 50, gross profit 50 divided by sales 100, gross profit 75 divided by sales 150. We will get the gross profit percentage, and we can really see, is there any growth in the gross profit percentage? What we find out is there is no growth in gross profit margin. The gross profit margin is the same. What happens here is the sales is 50 million, cost of sales is 25. The next period, sales is 100 million and cost of sales is 50 million. So the cost of sales has increased in line with the sales, and so the margin is always the same. This is very simple. You are selling something at 2 dirham, but you are buying it at 1 dirham. So your percentage is 50% profit. Again, in the next period, you sell something at 4 dirham, but you are buying it at 2 dirham. 4 minus 2 is 2. So there is again a 50% margin. In the third period, you are selling something at 10 dirham, but you are buying that at 5 dirham. Again, your profit margin is 50%. What happens here is the cost of sales is increasing exactly in line with the sales. If you can't reduce your cost of sales, your gross profit margin will always remain the same. Now, the director wants to know more about increase and decrease in gross profit margin. Generally, higher the ratio, the more efficient is the performance of the company. Generally, higher the ratio, the more efficient is the controlling of the direct cost. The direct cost is the purchase cost. Higher the ratio, the better is the sales mix and performance. So, here we give him some tips that if their purchase cost increases, gross profit will decrease. If closing stock decreases, gross profit will also decrease. Because he is only concerned with the losses, you need to show him that you cannot lose the gross profit. We also show him the format. Sales. Cost of sales has 3 items: opening stock, purchases, and closing stock. These 3 items together make the cost of sales. Total sales less the cost of sales gives us the gross profit. Now he wants to know more about increase in purchase cost means decrease in gross profit. Why and how? So we will show him through some mathematical figures. This is a what if analysis of MPLC. In period 1, MPLC sells 300, cost of sales opening stock is nil, add purchases 100 million, closing stock is 20. So the cost of sales is 80. 300 less 80 gives us the gross profit. Gross profit is 220 and the percentage is 73.30. What if everything else remained constant? The only change was purchase cost increased. If purchase cost increased, the cost of sales totally would increase. Then your gross profit would decrease. So would your gross profit percentage. See here, the gross profit percentage is decreasing. Now the director is pretty much concerned about the situation, and he thinks that if the purchase cost increases, there will always be a decrease in gross profit. This is right, but again, if gross profit decreases in any one period, that will actually not mean the business is performing very bad. For that period, yes, it might perform bad, but if you see the periods all together, maybe 3 or 4 periods, maybe the year, maybe 2 or 3 months as in a scenario, the whole picture, you might find out different things. The director wants to know more. Fall in gross profit and its percentage due to increase in purchase cost. This will not always mean poor performance. Before judging on a ratio, you need to have a look on the whole scenario. So here are the reasons. There might be a place for expansion. Maybe this is before Christmas Eve, maybe it is in November. So in November you might have to buy gifts at a higher price. The shop owners will need to buy gifts at a higher price because at that time there will be a greater demand and less supply. So you will have to buy at a higher price. So if you buy at a higher price, we know that your gross profit percentage is falling, but that this is only falling for one period. Again in December you are going to sell all these goods at a good price and you are going to make very good profit. So if we see November and December as the whole scenario, we will understand why this change is happening. Again, if you have very good gross profit percentage, it means that very soon many competitors will rush into this sector of business. Why? Because you are making very good profits, you are earning a good amount of money. Why should they not invest so that they can also earn good amount of money? So high gross profit percentage means many investors will be attracted towards your business, and there might be a very good competition in near future. The other tip was decrease in closing stock means decrease in gross profit. The director wants to know more on this topic. So here again is a what if analysis. MPLC in period 1 sales 250. In both cases everything is constant, only the closing stock is different. Decrease in closing stock, so here the closing stock is decreasing. If the sales were 250, cost of sales according to this period 1 was opening stock 0, purchases 150, closing stock minus 50. Closing stock should always be deducted from opening stock and purchases. Total cost of sales would be 100. Cost of sales 100 deducted from total sales would give me 150. So the gross profit percentage is gross profit divided by sales will give me 60% gross profit margin. Alright, what if the closing stock decreased? What would happen? If the closing stock decreased, the cost of sales would increase. Increase in cost of sales would give us a lower gross profit margin. Cost of sales is deducted from the total sales and the gross profit is found out. The gross profit divided by the total sales would give me the gross profit margin. But the director is very much annoyed. Why should there be decrease in closing stock? Are there any specific reasons? Let's find out. The closing stock may decrease due to some write-off. So the director wants to know what are these write-offs. The write-offs is sometimes due to perished goods, rotten goods. Say for example you are investing in tomatoes. Everyone knows that tomatoes should be stored in a very certain conditions. You bought 1000 kgs of tomatoes and in the end of the season or the period you find out that many tomatoes, 200 kgs of tomatoes has perished, has rotten. So you will have to remove them from your warehouse because you cannot sell them, you cannot eat them. So why keep them in your warehouse? You will have to throw them away. So when you are throwing away these tomatoes from your warehouse, you will have to write off from the financial statements. Again, your goods might be stolen. Monkeys might come and eat up all your bananas from your warehouse. Fire might destroy your warehouse. Natural disasters like flood and earthquake might destroy your warehouse. In that case, all your goods will be lost and you will need to write them off from your financial positions, financial statements. Again, new fashions might come up. If you are dealing in fashion accessories, then new fashions, new style, new trends, new brands with better fashions will really make your product obsolete. So you will need to write them off. Say for example you have 1000 pieces of t-shirts. By the end of the period you have 20,000 t-shirts left in your warehouse, but by the end of the season some new brand comes in with better quality t-shirts and with better designs. So your t-shirt sale has fallen. So you will need to write this off from your statement of financial position. You are not going to wear all the t-shirts all by yourself. There are many other techniques by which we will be writing off these goods, but that will be in another lecture. For this lecture, we need to understand the concept of write-off. Again, for IT softwares, every time there is a new and better version. You do not log on to the internet for 2 or 3 days, and after 3 days when you log on to the internet, the first thing you will see in your computer or in your laptop is that there is a pop-up. Your virus database is out of date. Please update. So only for 3 days if you are not in the internet and your virus database cannot update. So think about the other softwares. So if you have 100,000 pieces of a software DVD which you made, but by the end of the season you have 20,000 in warehouse still to be sold, and by the end of the season there is a new brand who have made better softwares, better versions, what will happen? Your sales will fall and you cannot sell many of the softwares now. So you will need to write them off. Hope you understand the concept of write-off. Alright, so let's wrap up. So what have we learned today? Can you remember? The first thing we learned was interpretation of financial statements, which is also known as ratio analysis. Then there are mainly 4 categories of ratio analysis: profitability ratio, liquidity ratio, long-term stability ratio, and investor ratio. These are mainly the 4 categories of ratios. Under profitability ratio, we have learned the gross profit margin. In gross profit margin, we have learned why the gross profit decreases. There are mainly 2 reasons. One is increased purchase cost will decrease your gross profit. The other is decreased closing stock will increase your gross profit. Alright, yes, so now you remember. So hope to see you in another lecture, and again we will repeat our auto-suggestion. Auto-suggestions are affirmations which we repeat to ourselves, and if we do it regularly before and after the study session, will help us learn faster and remember easily. Our auto-suggestion for today is: I can understand and remember whatever I read and hear in the class. I am able to present it very easily, both in speaking and in writing whenever I need. I can understand and remember whatever I read and hear in the class. I am able to present it very easily, both in speaking and in writing whenever I need. Thank you very much. That was all for today's lecture. Hope to meet you in another lecture. Bye bye.